Welcome to the second of our two-part webinar series providing an overview of insurance and insolvency in construction projects. Both of the webinars from this series are recorded and available on our Vimeo site if you would like to listen again or share with colleagues. Our first seminar was on insurance in construction projects. In this webinar, we will be considering the effect of insolvency on construction projects, how to protect against it, and what to do when you find yourself in that situation. The prospect of insolvency is, unfortunately these days, all too real, with the headline demise of Carillion and more recently and locally Crummock. Insolvency should therefore be borne in mind in respect of every construction project and at every stage. Just before we begin, to minimise background noise, I have placed you all on mute. If you would like to ask questions, please do so using the webinar chat function, and time permitting, we will answer some of these questions at the end. So your speakers today. My name is Sian Jeffries, and I'm a Senior Associate in the Projects and Infrastructure Disputes team, specialising in construction and engineering dispute resolution, based in Edinburgh. I am joined by Nathaniel Buckingham, our solicitor in the team. Our team regularly advises on construction contract issues and disputes across a range of projects and clients and through the whole life of the contract. We therefore have a great deal of experience in advising in circumstances such as insurance claims or insolvency situations, and this experience forms the basis of our strategic advice and what we will share with you today. So, I will now hand over to Nathaniel, who will take us through the agenda for this webinar.
Thanks, Sian. So, as Sian mentioned, we are focusing today on insolvency in construction projects. We will first consider the steps you can take prior to entering into a construction contract to reduce the risks associated with insolvency. We will then consider the contractual mechanisms which can be used to protect against insolvency. Next, we will look at typical warning signs which parties should look out for, which might be indicative of financial difficulties. Finally, we will address the insolvency provisions of two of the most popular standard form contracts, JCT 2016 and NEC 4, with respect to insolvency. One of the first things to consider when deciding whether to embark on a new construction project is, who are you entering into a contract with? Now that question should be asked whether you are the employer or the contractor, but it can often be overlooked because of business pressures to get the deal done or assumptions if a big name is involved. But considering this question prior to contracting can help to get a sense of the financial strength of your counterparty and avoid taking unnecessary risks. One useful source of information for limited companies is simply Companies House. Most information that is available from Companies House can now be accessed for free on their website. The latest company accounts will often be available. However, these may be abbreviated depending on the size of the company. They may also be somewhat historic depending on the timing of the company's financial returns. This should be one of the first ports of call in gaining an understanding of who you are contracting with. In addition, credit reference agencies can provide more detailed information about a company's financial standing. Note, however, that checking a credit rating will usually leave a footprint, which means that the party will be able to find out you have been checking their financial standing. Another way of learning about a prospective contractor is through the procurement process. The public sector always has to evaluate financial and economic standing through procurement regulations, but the private sector can choose to ask questions and seek information too. In the public sector, the European Single Procurement document includes template questions on turnover and confirmation that the bidder meets the requirements for compulsory employer's liability insurance. In the private sector context, pre-qualification questionnaires are common. These can set out questions for potential tenderers to answer regarding their level of experience, capacity and financial standing. Typically, you would ask the contractor to provide information on the last 2 years' accounts, turnover and current cash flow position, in addition to a banker's reference and confirmation that employer's liability and public liability insurance policies are in place.
Now that we have thought about some of the steps to review your prospective counterparty's financial standing prior to entering into a contract, we will consider some of the contractual mechanisms which employers and contractors in construction contracts can rely upon to protect against insolvency. We will start with employer protections. The first to consider is retention. Despite recent opposition and government preferences, it is still common practice for there to be a retention during the construction period. This, as you will know, is a proportion of the amount due to the contractor which the employer retains during the interim payment periods. This figure is often 5% for lower value contracts and 3% for higher value projects. Half of the retention is released at completion of the works and the other half held for a defined period after completion as security for the contractor's obligation to return to site to make good any defects. While for employers there is a significant lever, this clearly impacts upon the contractor's cash flow, adding to the many pressures that increase the risk of insolvency. It is also common for contractors to simply price in the retention on the assumption that they may not get all or any of it back, meaning that the employer is effectively paying for this security themselves. Another kind of employer protection is performance securities. Two such options are parent company guarantees or performance bonds. A parent company guarantee is a form of security where a parent company or another group company guarantees the obligations of another company in the group. If the child company is unable to meet its obligations, then the employer can call on the parent company. Often such guarantees are coextensive with the contract. This means that the employer is not required to pursue its remedies under the main contract. One of the possible limitations of parent company guarantees is that the parent company may also go into insolvency. If this occurs, the guarantee may not be worth very much. However, it will give the creditor the opportunity to submit a claim in more than one insolvency procedure, thereby potentially increasing the sum they recover. Carillion is a clear example of a parent company going into insolvency. A performance bond is provided by financial institutions and generally provides security for up to 10% of the contract price, where the contractor procuring the bond is in breach of contract or insolvent. There is a premium payable for such bonds, but this in itself can be a good barometer of the risk of dealing with the party in question. The higher the premium, the greater the risk. There are two broad types of performance bond. The first is an on-demand bond. Such performance bonds require the bondsman to pay where an effective demand for payment has been made, irrespective of whether there has been a breach under the underlying contract. The second is a conditional or default bond, where the claimant must establish the bond has been triggered, usually by breach of the underlying contract, and that it has suffered a loss. On-demand performance bonds are more expensive than conditional default bonds. Employers should also protect their rights in respect to design and copyright relating to the project. It is important for the employer to ensure it has access to drawings and documents from the contractor and, importantly, subcontractors and consultants, without having to pay any further sums in the event that the contract, subcontractor or consultant goes into insolvency. Employers should also seek collateral warranties from subcontractors which contain step-in rights. Collateral warranties are contracts ancillary to the main contract, which provide the employer with a direct right of action against the subcontractors. Step-in rights entitle the employer to step into the position of the contractor before the subcontractor is allowed to exercise its termination rights on a contractor insolvency event. So this means that if the contractor becomes insolvent halfway through a project, the employer would have the opportunity to take the place of the contractor in respect of the subcontract, ensuring as much continuity as possible. Another form of protection is provision for the employer terminating the contractor's employment or on contractor insolvency or on other triggers. Sometimes the employer might seek to be entitled to terminate at will. These are also sometimes known as termination for convenience clauses. The benefit of such clauses is that they allow the employer to terminate for any reason, avoiding the difficulties of proving, for instance, that the contractor has breached the contract. We will consider this in more detail below when we examine the provisions of standard form contracts.
So we will now look at some typical contractual provisions which can protect contractors. The first to consider is suspension clauses. These are contractual clauses which allow the contractor to suspend performance of the works, usually as a result of actual or alleged breaches of contract by the employer. Section 112 of the Construction Act specifically provides that where a party to a construction contract has not received payment in accordance with the terms of the contract, that party may suspend performance of all or any of its obligations as a consequence of that non-payment. This suspension option could be extended to other circumstances, provided, of course, that the employer will consider it. One step further than suspension is termination. As discussed above in the context of employer protections, termination clauses in favour of contractors can also be included. These can entitle the contractor to terminate the contract, for instance, for prolonged or repeated late payment or on the employer's insolvency, though of course a contractor terminating at will may not be palatable to many employers. Another protection clause for contractors is the retention of title clause. Such clauses preserve the contractor's ownership rights over materials which are used in the construction project prior to the materials being fixed. This means that if the employer becomes insolvent, the contractor does not lose the unfixed materials even if they are on site, as the contractor is still the legal owner. As discussed earlier, parent company guarantees are a common form of employer protection. However, these can also be requested by and used for the benefit of the contractor to guarantee that the contractor is paid in respect of the work carried out under the contract. By having an employer's parent company, rather than just a shell or subsidiary, guarantee the contract payments. Finally, contractors may request that employers deposit funds into escrow accounts as security for the employer's payment obligations. The way these work is that typically regular payments are required to be made by the employer into the account during the course of the building contract. If the employer falls insolvent, then the contractor is protected to some extent at least, as the funds in the escrow account will not be included with the employer's other assets for distribution to other creditors. Of course, with the exception of the statutory right to suspend, all of these protections would need to be agreed with an employer. So now that we've considered some of the protections which might be available and put in place in the construction contract, parties should remain alert to some of the warning signs through a project which could suggest that a party might be approaching insolvency. The first, and slightly less well-known warning sign, is a company having late submissions to Companies House, as this might well be indicative of mismanagement or financial difficulties. And there are other more obvious warning signs as well, which include excuses for non-payment. So if these are not credible or if they are indicative of poor financial standing, then it may be a cause for concern and further investigations. Or attempts to renegotiate price or cash flow, again, is another clear warning sign of financial difficulties. If there are delays in the delivery of materials or even paperwork such as performance bonds, both of which would suggest mismanagement which may be linked to poor performance. and on-site, high staff turnover is another indicator which might suggest that a company is not in a strong financial position. And there are some more obvious ones as well, court orders against the other party, which could affect the party's financial standing directly if they are required to pay compensation or penalties. And finally, there are often market rumours and market knowledge. Now, of course, rumours should be treated with the utmost caution. However, staying alert to industry chat may provide early warning of problems which have not yet been widely reported.
We will now move on to consider some statutory and contractual provisions which apply in cases of insolvency and construction projects. First, the Housing Grants Construction Regeneration Act contains a couple of relevant provisions. The first, Section 111(1), generally provides that where a payment is provided for by a construction contract, the payer must pay the notified sum to the extent not already paid on or before the final date for payment. However, the section goes on to clarify that this does not apply where A, the contract provides that if the payee becomes insolvent, the payer need not pay any sum due in respect of the payment, and B, the payee has become insolvent after the last date when a payless notice could have been served. It is important to note that this is not a statutory right to withhold payment against insolvent parties. If parties want this right, then they must put it in their contract. Section 113(1) states that a provision making payment under a construction contract conditional on the payer receiving payment from a third person is ineffective unless that third person or any other payment by whom is under the contract directly or indirectly a condition of payment by that third person is insolvent. The effect of this clause is to prohibit, in general, paid when paid clauses. These are clauses which make payment conditional on the payer receiving payment from a third party. However, there is an important exception to this general rule. Pay when paid clauses can be relied upon by a contractor to deny payment of outstanding amounts due to its subcontractors where the employer has become insolvent. Again, the contract and subcontracts must make specific provision for these circumstances. We will now look at two of the main standard form construction contracts. We'll focus on the JCT-SBCC standard form contract, the Design and Build Contract 2016. The insolvency provisions of the JCT and SBCC are identical, so our comments apply equally to both. The main provisions relating to insolvency in the JCT 2016 standard form are found in Clause 8. This clause addresses termination. The meaning of insolvency is defined in Clause 8.1, with subclauses 8.1 to 8.14 defining insolvency in relation to companies, partnerships, individuals and persons. They also account for equivalent insolvency arrangements or proceedings taking place in other jurisdictions. We don't intend to look at these definitions in detail, but it is important to note that if you are faced with an insolvency situation, you check and confirm that you are within a situation envisaged by the termination and insolvency provisions of Clause 8. If the contractor becomes insolvent, Clause 851 allows the employer at any time by notice to terminate the contractor's employment under the contract. Contractors are obliged to inform the employer if they become insolvent. As from the date the contractor becomes insolvent, whether or not the employer has given such notice of termination, the contractor's obligations to carry out and complete the works and design of the contractor's design portion shall be suspended, and the employer may take reasonable measures to ensure that the site, the works and the site materials are adequately protected and that such site materials are retained on site. The contractor shall allow and shall not hinder or delay the taking of those measures. Clause 8.7 sets out the consequences of termination, including in cases where the termination has occurred due to insolvency on the part of the contractor. The employer may employ and pay other persons to carry out and complete the works. The employer may require the contractor to remove temporary buildings, plant, tools, equipment, goods and materials belonging to the contractor, provide the employer with copies of all the contractor's design documents, and assign to the employer the benefit of any agreement for the supply of materials or goods and/or for the execution of work. Once the works have been completed, an account for the employer's expenses is prepared, detailing where any direct loss, damage has been caused to the employer for which the contractor is liable, whether arising as a result of termination or otherwise. A settling up exercise can then take place, depending on which party owes the other money. Clause 8.8 provides for scenarios where within 6 months of the date of termination, the contractor's employment, the employer decides not to have the works carried out and completed. In addition to contractor insolvency, the JCT provides for employer insolvency. Clause 8.10.1 provides that if the employer is insolvent, the contractor may, by notice to the employer, terminate the contractor's employment under this contract. As with the contractor's insolvency provisions, if the employer becomes insolvent, the contractor's obligations to carry out and complete the works shall be suspended. Clause 8.12 addresses what happens if the contractor's appointment is terminated in certain situations, including due to employer insolvency. No further sums become due to the contractor. The contractor shall remove or procure removal from the site of any temporary buildings and provide to the employer copies of documents referred to in Clause 237, being the contractor's as-built drawings. An account shall also be prepared. This will take into account factors such as the total value of the work carried out at the date of termination, the reasonable cost of removal, the cost of materials or goods properly ordered for the works for which the contractor then has paid or is legally bound to pay, and any direct loss and/or damage caused to the contractor by termination.
So turning now to another popular form of standard form contract, NEC4. Whilst we appreciate that many contracts still use NEC3, NEC4 is bedding in and beginning to be used much more frequently. So it's appropriate that we look at the latest form, although there are, of course, many similarities with NEC3. The provisions relevant to insolvency are found in Section 9, which contains clauses 90 to 93 of the core clauses, which, as with the JCT SBCC contract, is the termination section. Clause 91.1 sets out the reasons why either party may terminate the contract. This sets out and includes the various insolvency, administration and bankruptcy reasons that allow either party to terminate. This clause provides rights to both employers and contractors on the insolvency and other related triggers of the other party. And just like with JCT SBCC, it is important to check the insolvency circumstances and definitions to confirm that you are within one of the reasons for termination envisaged by these provisions of Section 9. NEC4 then sets out in a table format the procedures that have to be followed depending on whether it is the contractor or the client terminating, and depending on which reason is being used for termination. The termination procedure when the contractor has fallen insolvent and the client is terminating is procedures P1, P2 and P3. The termination procedure when the client has fallen insolvent and the contractor is terminating is set out in P1 and P4. So taking each of those in turn, P1 says that on termination, the client may complete the works and may use any plant and materials to which it has title, and that applies in both cases regardless of who is terminating. P2 says that the client may instruct the contractor to leave the site, remove any equipment, plant and materials from the site, and assign the benefit of any subcontract or other contract related to performance of the contract to the client. And this is only available if it is the client who is terminating. P3 says that the client may use any equipment to which the contractor has title to complete the works, and also that the contractor will promptly remove the equipment from site when the project manager informs the contractor that the client no longer requires it to complete the works. Again, that is only available if it is the client who is terminating. And P4 says that the contractor leaves the working areas and removes the equipment, and that applies only if the contractor is terminating. The NEC4 termination table then also sets out what payments are due on termination. So the payments due when it is the contractor that has fallen insolvent and the client is terminating are A1 and A3. The payments due when it is the client that has fallen insolvent and the contractor is terminating are A1, A2 and A4. Again, taking each of those in turn, A1 includes an amount due assessed as for normal payments. It includes the defined cost for plant and materials, whether within the working area or to which the client has title and of which the contractor has accepted delivery. It also includes other defined costs reasonably incurred in expectation of completing the whole of the works, and any amounts retained by the client, and a deduction of any unrepaid balance of an advance payment. And this payment, this overall payment of A1, applies in both cases, and it is effectively the reasonable and proper costs of the work done at the date of termination. A2 is the forecast defined cost of removing the equipment, and this is only payable and only applies if it is the contractor terminating. A3 is a deduction of the forecast of the additional cost to the client of completing the whole of the works, and that only applies if it is the client who is terminating. And A4 is a fee percentage applied to any excess of the total of the prices or the first forecast of the defined costs over the price for work done to date, and that is only applicable if it is the contractor terminating because of a client's insolvency. And that is essentially, so A4 is essentially the profit and overheads of the work lost through termination, and that, as I say, is only if the contractor is terminating. So with NEC4, it is therefore always a case of working out firstly what your reason is for termination, and in these circumstances it is one of the insolvency reasons, number 1 to 10, and then you simply follow the procedure and amount due that's set out in the table. This is a very prescriptive but straightforward way of working through an insolvency situation. We have now come to the end of this webinar, which we hope has been useful and interesting. We do apologise for the slight technical hitch and background noise at the start of the webinar. We hope that didn't disrupt you too much. So we still have a few minutes to answer any questions. If you haven't already done so, please do type your questions into the chat box now. Whilst you're doing that, I will just take the opportunity to remind you that this is the second webinar in our two-part series, and that both of the webinars from this series have been recorded and will be available on our Vimeo site if you would like to listen again or share with colleagues. We will also be running an autumn webinar series and also autumn in-person seminars, so please keep an eye out on your emails and on our website, and do sign up to those if they are of interest.
We'll give you a moment for some questions. But if there aren't any today, then I do hope that you've enjoyed the webinar and found it informative and useful. And we look forward to welcoming you to future webinars and seminars.